Currency valuation and revenue generation. The valuation of the US dollar, a critical component of the American monetary system, depends on the interplay of supply, demand, and global trust, shaping its role in a $150 to $200 trillion economy. Since the end of the gold standard in 1971, when the dollar was valued at $35 per ounce of gold, its worth has been determined by market dynamics rather than a fixed commodity. The Federal Reserve manages this valuation through monetary policy tools, including setting interest rates at 4.75% to 5% in 2025 and conducting open market operations by purchasing U.S. Treasury securities. These purchases, crediting bank reserve accounts, inject money into the economy, supporting the $45,560 billion federal debt and stabilizing bond markets by preventing sell-offs at a loss. The dollar's global prominence, with $8 trillion held in foreign reserves, reinforces its value, but excessive money creation can lead to inflation, reducing purchasing power, as observed during the price spikes of 2022 to 2023. The money supply, measured as M2 at $21,560 billion in 2025, reflects the cumulative effect of fractional reserve banking, where banks create money through loans for both real property and consumable goods. Real property loans, such as mortgages for houses within the $48,200 billion real estate sector, are secured by tangible assets, providing stability as banks can repossess property in case of default. Consumable loans, like a $1 credit card purchase for bubblegum, are unsecured, relying on repayment promises and carrying higher risks of contributing to inflation if overextended. The scale of lending is evident in the $20,400 billion household debt and $21,600 billion business debt in 2024, which drive economic transactions but require careful management to avoid destabilizing markets, as seen in the 2008 housing crisis triggered by excessive mortgage lending. The Federal Reserve generates revenue to fund its operations, ensuring it remains independent of congressional funding. The primary revenue source is interest on securities, including treasury bonds, agency debt, and mortgage-backed securities, which constitute over 90% of its income. For example, a $1 billion treasury bond yielding 4% generates $40 million in annual interest, a significant contribution to the Fed's finances. Additional revenue comes from fees for financial services, such as check clearing, automated clearinghouse transfers, FedWire funds transfers, and the FedNow instant payment system, which collectively earned $500 million in 2023. The Fed also earns interest on discount window loans, provided to depository institutions facing liquidity shortages, and on foreign currency investments, reflecting the dollar's role in a $100 to $115 trillion global money supply. These revenues fund operational costs, including $1,100 million in employee salaries, $1 billion for currency production, and $700 million for the Consumer Financial Protection Bureau in 2023. After covering expenses and paying $1,500 million in statutory dividends to member banks, the Federal Reserve remits excess earnings to the U.S. Treasury, contributing to the $5 trillion in federal revenue in 2024 and reducing the $1,900 billion deficit. This remittance supports public programs, from infrastructure to defense, benefiting taxpayers indirectly. The Fed's revenue is stored digitally as securities and reserve balances, with gold holdings, valued at $42.22 per ounce in 2025, playing a minimal role compared to electronic assets. The Fed's hybrid structure, with a public board of governors and privately structured regional reserve banks, allows it to generate and manage revenue independently, though congressional oversight through hearings and audits ensures accountability. However, exemptions for monetary policy decisions spark debate over transparency, as the public sees aggregate figures but not detailed transaction data. Market fluctuations, such as the 2008 housing crisis, highlight the challenges of maintaining currency stability, requiring Federal Reserve intervention to balance growth and inflation. The dollar's value depends on confidence, supported by its global role, but risks from overlending or external factors, like trade imbalances, necessitate vigilant management. The Fed's revenue generation and currency valuation efforts are integral to sustaining economic stability, ensuring the dollar remains a trusted medium in domestic and international markets.